Welcome everyone. Thank you for joining us in our video today. And I thought we'd talk about bonds. We'll have a bit of a deep dive into it. I think because it's a often misunderstood asset class and it does comprise a large part of most multi-asset class portfolios. So to do justice to this particular subject, what I thought I'd do is look at the structure, the maturities of the bond market, also look at some of the types of bonds, look at the risks, and then what it might mean for you. So the structure of the bond market. Well, the major investors and purchasers of bonds are other governments and other central banks, and they all invest in each other's bonds. And the other major institutions involved are the financial institutions like the banks and the insurance companies. But other long-term holders of bonds as well are the endowment funds, the charities, the family offices, the sovereign wealth funds as well. Now, alongside of that, you have the ETF providers and the fund managers, and also perhaps retail investors like you and me, which make up the smaller parts of the actual market. The size of the market is enormous. So the bond market, according to the US securities body, SIFMA, has a valuation of 120 trillion US dollars as at today. And the daily trading in government bonds globally is about $700 billion. So those two figures are huge and far exceeds that of the stock exchange. Now, as well as this size, we need to think about other huge institutions that influence bond markets, and those are the credit rating agencies. So those would be Standard & Poor's, Fitch, Moody's. And simply put, it's their job to assess each bond as an issue and look at the credit and default risk. And then once they've done their work, their research, what they do is they provide a grade. So investment grade is usually around A down to B, and then C to D is perhaps considered junk or non-investment grade. So in this way, you as an investor can see where and why certain bonds have the yields they do, why some are higher than others. Generally, the riskier and the more likely of a default risk, the higher the yield. So let's look at maturities. So just to recap, in terms of bonds are an IOU, and that money is returned to you at a fixed point in the future. Now that term varies. It can be a few weeks from now, or it could be up to 100 years from now. So when you look at those different maturities, you as an investor are going to want a higher yield. You're going to want a higher yield for the longer term maturity than perhaps something you're going to get your money back in a few weeks' time. So the way this is all depicted on a graph is with something called a term structure chart or a yield curve. And the yield curve is usually an expectation of different interest rates of different maturing bonds. So in this way, you can get a sense, especially when you look at the government bond market, you can get a sense of where the market thinks interest rates are going to be over the next 2 years, 10 years, 30 years. So it actually is quite a good economic indicator as well. And that yield curve does move and change around based on expectations of interest rates and inflation. Now let's look at the different types of bonds. So corporate bonds. So those are bonds which are issued by companies. It's really as simple as that. And the other type of bond I want to discuss are inflation-linked bonds. And those are bonds where the income and the money that's returned to you is linked to an inflation index, sometimes RPI. Thinking about the different risks now, I think that's quite important when you're thinking about any investment. So the main risk really is inflation risk. So with a bond, it is a asset class which is paying you a fixed income. And that's agreed at the start of the issue. So over time, you're getting a fixed amount. However, inflation could be increasing. And that erodes the actual real return of the income that you're receiving. So those are things that you need to be thinking about as a risk. Another risk is default risk. And we talked already about the credit rating agencies and their role. Another risk is liquidity. So the minimum sizes for investing in the bond markets are sometimes a little bit larger than in the stock exchange. And the ability to sell quickly might not be as quick or might not be as efficient. Another risk is valuation. We have to take into consideration the monetary policy actions of central banks over the last 20 or so years. And what's happened is that with all the purchases of bonds, with the QE, what we have now is many parts of the bond market which are considered at elevated prices, where bond yields are at sometimes negative yielding. So we've talked about the risks. Let's think about what this means for you in terms of investing. Is this accessible? Yes, this is a super accessible asset class. It can be accessed through a fund, a mutual fund, unit trust. It can be accessed through an ETF. For those more experienced, they can also invest directly on their online trading platform if they so wish. Another feature to think about is the fact that economies, large and small, globally are changing constantly, and you need to be thinking about and researching about the economies which might be improving over the long term. So you need to be assessing whether the credit rating improves, and with that credit rating improving of those economies over the next 20 or 30 years, you could actually be seeing some capital growth as well. So you do need to be thinking about that, researching. So to recap over what we've discussed today, what we've looked at is the structure and the mechanics of the bond market. We've looked at maturities, the yield curve, a few other types of bonds for you to consider, and we've looked at some of the risks and what this might mean for you as well as an investor. So I hope you've liked, I hope you have some comments, and I'll speak to you all very soon. Bye.